In 1929, the US stock market crashed, and what followed was a global disaster, the Great Depression. At its peak, unemployment reached 25% in the United States, with millions of people losing their jobs, homes, and savings. But here's the shocking part: during this time, the stock market lost almost $30 billion in wealth. That's over $400 billion in today's money. But while most people were running in fear, a few smart investors saw something different: opportunity. In this video, we'll show you how the Great Depression wasn't just about loss. For savvy investors, it was about finding the gems buried beneath the panic. Imagine buying stocks for a fraction of their true value, businesses that would later grow into giants. How did they do it? How can you apply the lessons learned during this massive financial collapse to your own investment strategy today? Stay tuned as we dive into these surprising strategies, uncover lessons from the past, and reveal how value investing can turn uncertainty into long-term success. Chapter 1. The crash heard round the world. In 1929, the world witnessed one of the most significant economic events in history, the stock market crash. On October 29, known as Black Tuesday, the market lost nearly 13% of its value. That was just the beginning of the Great Depression. It wasn't just Wall Street that was affected. This global crisis spread to farms, factories, and households. The economic downturn wiped out billions in wealth, but out of this chaos, something unique emerged: opportunity. Investors were panicking, selling off stocks, which created a market flooded with undervalued assets. While most people were gripped by fear, a few saw potential where others saw disaster. The key lesson here? Panic creates opportunity. As a value investor, one of the first things you learn is that downturns can be your best friend. When prices fall, the best businesses become bargains. By the end of 1929, many stocks were trading at prices below their real worth. According to the famous investor Benjamin Graham, this was a signal for investors who could afford to wait. In his book The Intelligent Investor, Graham said, "In the short run, the market is a voting machine; in the long run, it is a weighing machine." The market had lost its balance, and those who could be patient had the chance to make a smart investment. Even though the crash led to a period of uncertainty, savvy investors recognized the importance of looking at the intrinsic value of a company. They focused on businesses that were selling for less than their actual worth, essentially, buying stocks for less than what they were worth. This principle is at the core of value investing. Chapter 2. The birth of bargain hunting. In the aftermath of the Great Depression, many businesses faced challenges. But for the patient investor, this crisis also created an opportunity to find bargains. Some companies, despite difficult times, remained fundamentally strong. The trick was recognizing those companies early on. A great example of this is the investment strategy used by Warren Buffett, one of the most successful value investors of all time. In his early years, Buffett read Benjamin Graham's security analysis and adopted its principles. One of his favorite strategies is buying companies with strong fundamentals but undervalued stock prices. A few companies, like Coca-Cola, were trading at bargain prices in the 1930s. Coca-Cola was not immune to the Depression, but its brand strength and long-term potential made it a valuable investment. In fact, Buffett bought a large stake in Coca-Cola in the late 1980s, well after the Depression, but the company's longevity showed how strong, enduring businesses were undervalued even in tough times. Studies of the Great Depression show that the best performing stocks during the period were often those with a low price-to-earnings ratio. Investors who focused on companies with consistent earnings and a solid track record could take advantage of bargain prices. The market, in its panic, often ignored companies with strong fundamentals, opening the door for value investors to step in. During the Great Depression, the market often misunderstood the future potential of companies. This mispricing created opportunities for those who focused on buying good businesses at fair prices. When looking for value, investors need to think beyond the moment and look at long-term stability. As Warren Buffett said, "It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price." Chapter 3. Value investors versus speculators. A battle for survival. While the stock market crash of 1929 wreaked havoc, it also highlighted a major divide between two types of investors: speculators and value investors. Speculators, driven by short-term gains, were often the first to sell when the market turned sour. They were reacting to the moment, not considering long-term potential. This led to massive sell-offs, which further fueled the downturn. On the other hand, value investors stayed calm, focusing on the underlying strength of businesses rather than day-to-day market fluctuations. They understood that the market's short-term volatility doesn't always reflect the true value of a company. During the Great Depression, value investors were able to pick up stocks at extremely low prices. They recognized that the market had overreacted, selling off solid companies that were temporarily affected by the economic crisis. While speculators lost their money in panic-driven decisions, value investors waited for the market to recover and enjoyed significant gains in the long run. It's a lesson we can still apply today. The value investing strategy emphasizes patience and discipline. It's about buying into strong companies when they are undervalued, not chasing after the latest trend or trying to predict the next big thing. Speculation might lead to short-term rewards, but in the long run, it's the steady, rational investors who come out on top. One of the greatest success stories from the Great Depression came from John Maynard Keynes, a famous economist who transitioned from being a speculator to a value investor. After losing a significant portion of his wealth in the crash, Keynes shifted his focus. Instead of relying on speculation, he began investing based on the long-term value of companies. While speculators rely on timing the market, value investors focus on the fundamentals. The Great Depression proved that the market is cyclical, and what goes down will eventually go back up. Understanding this cycle allows investors to identify opportunities to buy valuable companies when they are temporarily overlooked. As value investors, we should remember the lessons of 1929. The market is unpredictable, but solid businesses with strong fundamentals tend to weather the storm. In the words of Benjamin Graham, the investor's chief problem, and even his worst enemy, is likely to be himself. Overcoming our emotions, particularly fear, can be the key to successful investing during tough times. Chapter 4. Lessons from the Dust Bowl. Resilience in investing. While the Great Depression was shaking the stock market, the Dust Bowl was devastating agriculture. Between 1930 and 1936, a series of severe droughts hit the Great Plains, leading to crop failures and widespread poverty. This environmental disaster forced thousands of farmers off their land. Yet, despite the hardship, this period taught investors an important lesson about resilience. In value investing, resilience is crucial. Companies that can withstand external shocks, like natural disasters or economic crashes, are often the best long-term investments. The businesses that survived the Dust Bowl had strong fundamentals, and they bounced back when the conditions improved. For example, during this time, companies that provided essential services like food production, utilities, and transportation maintained their value. Warren Buffett often talks about the importance of investing in companies with economic moats, a term used to describe a business's ability to protect itself from competitors. These companies tend to be more resilient in tough times. During the Dust Bowl, businesses like railroads and large utilities were able to stay afloat because they provided essential services that people needed regardless of the economic climate. The concept of resilience in investing goes beyond surviving difficult times. It's about identifying companies that will grow stronger after a setback. Companies with a history of adapting to challenges often present the best investment opportunities. The Great Depression and Dust Bowl period showed that businesses with solid financial structures, a loyal customer base, and efficient management systems were better equipped to recover. The resilience of companies during the Dust Bowl is echoed in the words of Benjamin Graham. The investor's primary aim should be to preserve capital, and only secondarily to grow it. This advice proves true not just in a downturn, but also in times of environmental disaster. In such challenging times, resilient companies that survive are often poised for growth in the recovery phase, making them great long-term investments. Chapter 5. The New Deal, Government Intervention and Stock Market Recovery. The government's role during the Great Depression was pivotal in restoring confidence in the economy. President Franklin D. Roosevelt's New Deal programs, implemented in the 1930s, focused on relief, recovery, and reform. This massive government intervention helped stabilize the economy and eventually set the stage for a market rebound. For investors, this was a crucial moment that underscored the importance of understanding government policies when making investment decisions. Value investors take into account macroeconomic factors like government policies because these can have a huge impact on markets. For instance, during the Great Depression, the Federal Reserve's policies to reduce interest rates helped make capital more accessible. These policies provided an environment where businesses could grow, and their stocks could regain value. The New Deal also introduced important reforms, such as the creation of the Securities and Exchange Commission, SEC, which regulated the stock market and aimed to restore investor confidence. The SEC regulations helped ensure that companies were more transparent about their financial health, which is crucial information for value investors looking for reliable, trustworthy stocks. Interestingly, studies of the era show that industries directly supported by the New Deal, like construction and infrastructure, saw rapid growth. This shows the value of keeping an eye on government spending when making investment choices. Value investors who noticed the emphasis on infrastructure and public works projects had a chance to invest in companies that would benefit from the government's focus. Investors can learn from the New Deal by recognizing that the government can play a big role in driving market recovery. When assessing the potential for a market rebound, it's essential to look at the government's actions and how they may affect certain industries. As Roosevelt once said, "The only thing we have to fear is fear itself." In other words, during times of uncertainty, it's important to focus on the opportunities created by government policies rather than panic. Chapter 6. Depression-Proof Stocks. Identifying timeless value. One of the most important lessons from the Great Depression is the value of identifying businesses that are depression-proof. These are companies that provide products or services that people need no matter what the economic situation is. The idea is simple: during tough times, essential products are still in demand. These businesses tend to have strong balance sheets and steady earnings, which make them excellent long-term investments. Some industries are naturally recession-resistant. For example, utilities, healthcare, and food production are all sectors that provide essential services. Even during the Great Depression, people still needed electricity, healthcare, and food. In fact, utility companies performed relatively well during the Depression, showing that businesses in these sectors are more likely to withstand economic storms. As a value investor, focusing on companies with steady demand is a smart strategy. In fact, companies like Procter & Gamble and Johnson & Johnson were able to continue growing even during the worst years of the Depression. Their business models were built on consumer staples, products people buy regularly, regardless of the economy. The key to identifying depression-proof stocks lies in looking for companies that are less likely to be affected by short-term market fluctuations. According to legendary investor Philip Fisher, the stock market is filled with individuals who know the price of everything, but the value of nothing. This quote highlights the importance of understanding a company's long-term value rather than being swayed by short-term price changes. During the Great Depression, value investors who focused on these essential companies found great success. They didn't chase after the latest trends or volatile sectors. Instead, they invested in companies with solid fundamentals and long-term viability. Over time, these companies bounced back stronger, demonstrating the power of sticking with resilient, value-based investments. As a modern-day investor, the key is to look for companies with a strong track record, essential products, and a solid financial foundation. These types of companies are likely to continue to grow and perform well even in tough economic times. By following this strategy, investors can build a portfolio that's designed for long-term success, no matter what the future holds. If you enjoyed this video and want to learn more valuable investing strategies, don't forget to subscribe for more tips and insights. Investing in times of uncertainty can be challenging, but with the right mindset and approach, you can thrive even in tough markets.